Part 1, the Friday afternoon signal. It happened on a quiet Friday afternoon in mid-November 2025. While the rest of the financial world was distracted by the usual noise of daily tickers and political headlines, a single document was uploaded to the Securities and Exchange Commission's database that should have triggered air raid sirens on Wall Street. The filing was a standard 13F form from a firm called Scion Asset Management. To the uninitiated, it looked like just another quarterly update, but to those who know the history of financial collapses, seeing this specific name pop up on the terminal was a terrifying sense of déjà vu. The man behind the filing was Michael Burry, the legendary investor who famously predicted the 2008 housing collapse while the rest of the world was blindly buying subprime mortgages. And what he just revealed isn't just a bet against a stock. It is a $1.1 billion declaration of war against the single most crowded trade in human history. According to the filing, Burry has opened massive, high-conviction bearish positions against the two pillars of the artificial intelligence economy, Nvidia and Palantir. This isn't a hedge. This is a bet that the narrative of the last 3 years is a lie. But here's the part that the mainstream financial news left out. At the exact same moment, Burry was placing his chips on the table. A proprietary metric we track called the insider sell-to-buy ratio quietly spiked to a level we haven't seen since February 2007. The very CEOs telling you on CNBC that we are entering a new golden age of artificial intelligence are currently dumping their personal shares at a rate of $17 sold for every $1 bought. They are heading for the exits, and they are leaving the door open for you to walk in. We are currently sitting on a $10 trillion paper fortune that is strictly dependent on one fragile assumption that the AI boom will continue forever. But in this video, I am going to show you the 3 kill signals that just flashed red in November 2025. I'm going to show you the specific mathematical date in 2026 when the liquidity is guaranteed to dry up. And I will explain why this isn't just a correction. It is what I call the Great Vaporization, a market event that will erase trillions of dollars in wealth before the average investor can even log into their brokerage account. Part 2, the mathematics of delusion. To understand why this crash is mathematically guaranteed, you have to look past the hype and look at the plumbing of the market. You have to look at the return on investment gap. For the last 18 months, companies have committed over $1 trillion to artificial intelligence infrastructure. They are buying chips, building data centers, and rewiring the power grid. But here's the dirty secret that Wall Street analysts are terrified to put in their reports. Almost none of that money is coming back. Let's look at the numbers. Microsoft spent over $60 billion on AI infrastructure in the last 2 years. Their estimated revenue from those specific AI features? Less than $15 billion. That is a 4-to-1 spending ratio. They are spending $4 to make 1. OpenAI, the company that started this entire gold rush, is burning through cash at a rate that would make a 1990s dot-com startup blush. They are generating roughly $3.5 billion in revenue, which sounds impressive, until you realize they are burning over $5 billion annually just to keep the lights on. Their business model is effectively selling dollar bills for 90 cents and hoping to make it up on volume. This isn't a growth phase, this is structural insolvency, masked by venture capital. The market has priced companies like Nvidia as if this spending will not only continue, but accelerate exponentially forever. Nvidia's valuation assumes that companies will spend $600 billion in 2025, $800 billion in 2026, and over $1 trillion in 2027. But corporations operate on budget cycles, and right now, in late 2025, the CFOs of the world are looking at the billions they spent on AI in 2024 and asking a very simple question. Where is the profit? When they realize that the AI tools are useful, but not generating trillions in new profit, the order will come down to cut capital expenditure. This is what we call the CapEx wall. It is the moment the music stops. When Microsoft and Google cut their orders for new chips, Nvidia's revenue doesn't just flatten, it collapses. And because Nvidia is now the engine of the entire S&P 500, when it stalls, the entire market enters a free fall. Part 3. The physics of the crash. But even if the money was there, the physics aren't. There is a hard, physical constraint to the AI bubble that almost no one is discussing. Energy. We have all heard that AI data centers are power hungry, but the scale of the problem is effectively being censored by the industry. Training a single large model like GPT-4 required 50 gigawatt hours of electricity. That is enough to power thousands of homes for a year. But that was just for training. Running these models, answering your questions, generating your images, requires a continuous stream of power that the US grid simply does not have. By 2027, AI data centers are projected to consume over 100 terawatt hours of electricity annually. To put that into perspective, that is the entire electricity consumption of a country like Sweden. We cannot build nuclear power plants in 2 years. We cannot upgrade the entire national grid in 18 months. The infrastructure required to support the stock price of Nvidia literally does not exist. We are already seeing the cracks. In Northern Virginia, the data center capital of the world, power utilities are already turning away new AI projects because the transmission lines are melting. This creates a physical ceiling on growth. Even if companies wanted to spend $1 trillion on more chips, they have nowhere to plug them in. This is the energy wall, and when the market realizes that growth is physically capped, the infinite growth valuation models collapse instantly. Part 4, the smart money exodus. If my analysis sounds pessimistic, you don't have to take my word for it. You just have to look at what the billionaires are doing with their own money. Let's go back to Michael Burry. In his Q3 2025 filing, he didn't just dip his toe in, he bought put options on Nvidia and Palantir with a notional value estimated at over $1.1 billion. Burry's thesis is based on the pick and shovel fallacy. The market assumes that because everyone needs Nvidia chips to build AI, Nvidia will be profitable forever. It's the same logic that said Cisco Systems would be the most valuable company in the world forever in 2000, because everyone needed routers for the internet. But Burry knows what happened to Cisco. It lost 80% of its value in months, not because the internet failed, the internet obviously succeeded, but because the infrastructure build-out finished. Once everyone had a router, they didn't need to buy a new one every year. We are seeing the exact same pattern today. Burry is betting that the upgrade cycle for AI chips is about to hit a brick wall, but Burry is just one man. The louder signal is coming from Omaha. Warren Buffett, the most patient investor in history, is currently sitting on a cash pile of $381.7 billion. Let that number sink in. Warren Buffett has more liquid cash available than the United States Federal Reserve has in its operating account. He holds more treasury bills than most sovereign nations. Buffett's job is to find companies to buy. The fact that he is hoarding $382 billion tells you one simple truth. He cannot find a single thing worth buying. In his view, the entire stock market is a bubble. He has sold half of his Apple stake. He has dumped Bank of America. He is effectively closing out his positions in the American dream and moving into the only asset he trusts, short-term government debt. Buffett lived through the 1970s. He lived through 2000 and 2008. He knows that when valuations detach from reality, the reversion to the mean is violent. He isn't trying to time the top. He is simply stepping off the tracks before the train derails. Part 5, the mechanism of vaporization. So, how does the crash actually happen? How does $10 trillion vaporize? It's important to understand that vaporization isn't just a scary word. It's a specific market mechanism related to liquidity in the age of passive investing. In 2025, the stock market is broken. It is no longer a market of individual stocks. It is a market of passive flows. The Magnificent Seven stocks now account for over 37% of the S&P 500. This concentration is unprecedented. It means that the S&P 500 is essentially just a leveraged ETF on artificial intelligence. Here is the nightmare scenario for 2026. It starts with a catalyst. Maybe it's Nvidia missing an earnings call because Microsoft cut its order. Maybe it's the grid failing in Virginia, or maybe it's just exhaustion. Nvidia drops 10% because Nvidia is such a massive part of the index. The S&P 500 drops 2%. This triggers the passive doom loop. Millions of Americans have their 401ks on autopilot. But there are also massive algorithmic funds that target volatility. When the S&P drops and volatility spikes, these mathematical models are programmed to sell automatically. To sell the index, the ETF providers have to sell the underlying assets. What do they have to sell the most of? Nvidia, Apple, Microsoft. This selling pressure drives the stocks down further. Nvidia drops another 10%. Now the options market kicks in. There are trillions of dollars in call options betting on these stocks going up. As the price falls, market makers who sold those options have to de-hedge, meaning they sell the stock to protect themselves. Suddenly, you have everyone selling at once. The algorithms, the option dealers, the terrified retail investors, and the insiders. But who is buying? Buffett isn't buying yet. He's waiting for the bottom. Burry isn't buying. He's profiting from the fall. The passive funds can't buy. They strictly follow the index. This creates an air pocket. The price doesn't slide down. It gaps down. You wake up and your portfolio's down 20%. You try to sell, but the price is already lower. This is how liquidity vaporizes. It's what happened in 1987, and the structure of the market today is 10 times more fragile than it was then. Part 6. The psychology of the trap. This brings us to the most dangerous part of the cycle, the return to normal trap. In every bubble, there's a phase right before the end where the market wobbles, drops, and then rallies back up. Everyone breathes a sigh of relief. It was just a correction, they say. Buy the dip. That is happening right now in late 2025. The market is choppy. We saw Nvidia lose $200 billion in a week and then bounce back. This is the trap. The smart money uses this return to normal phase to unload their remaining positions into the hands of retail investors who think they are getting a bargain. They need you to stay bullish so they can get out. That is why you are seeing so many headlines about how AI is just getting started and the volatility is temporary. These headlines are the exit liquidity marketing campaign. But if you look at the insider sell-to-buy ratio of 17.32, you see the truth. They are selling. You are buying. I am going to keep tracking this insider ratio, along with the energy wall data, every single week on this channel. When the insiders finally stop selling and start buying again, that will be the signal that the bottom is in. If you want to be alerted the moment the smart money flips bullish, so you don't miss the generational opportunity to buy at the bottom, make sure you subscribe and turn on notifications. You do not want to be late for the recovery. Now, the $10 trillion question, what do you do right now to protect your money? Part 7, the solution, let's get real. If you listen to the mainstream media, they will tell you to hold on and dollar cost average. But remember, the people telling you that are the ones selling their shares to you. If you look at what the billionaires are actually doing, a different picture emerges. They are moving into real assets. Number 1, cash and short-term treasuries. Like Buffett, having liquidity allows you to survive the crash and buy assets when they are cheap. High-yield savings and T-bills are the bunker for this storm. It's boring, but boring is what saves you when the building is on fire. Number 2, physical gold. Central banks are buying gold at the fastest pace since 1950. Why? Because gold is the only asset that isn't someone else's liability. When the tech bubble bursts, it often triggers a loss of faith in the currency itself. Gold is the hedge against the central bank panic that will inevitably follow the crash. Number 3, defensive sectors. Look at what Michael Burry is buying. He has been quietly buying call options on companies like Halliburton for energy and Pfizer for healthcare. These are sectors that people need regardless of whether an AI chatbot can write a poem. They are the anti-bubble trades. Energy keeps the lights on. Healthcare keeps people alive. Tech just keeps people entertained. In a depression, entertainment is the first thing to go. Number 4, farmland. It's not just Bill Gates. The ultra-wealthy are aggressively buying farmland. It's a tangible asset that produces essential goods and cannot be vaporized by a computer algorithm. We are seeing a massive rotation out of financial assets, paper, and into real physical assets. The story of the last 3 years has been the story of artificial intelligence. It has been a story of wonder, of hype, and of greed, but every story has an ending. The signals are flashing red. Michael Burry is short, Warren Buffett is in cash. The insiders are selling, the energy grid is maxed out, and the calendar is turning toward the 2026 capex cliff. You have a choice right now. You can continue to believe the narrative that this time is different, that trees grow to the sky, and that AI will make everyone rich. Or you can look at the data, look at the actions of the smartest money in the room, and prepare for the vaporization. The AI bubble is going to burst. The only question is, will you be watching it from a position of safety, or will you be part of the liquidity that disappears? But here is the truly scary part. The stock market crash is just the trigger. It's the first domino. When $10 trillion in collateral vanishes from the stock market, it exposes a much deeper, much more dangerous rot in the financial system. There is a shadow market hidden in the banking system worth $600 trillion. It's called the derivatives market. And when the volatility from the AI crash hits the banking sector, that time bomb is going to explode. I've spent the last month digging into the bank balance sheets, and what I found makes the 2008 financial crisis look like a picnic. You need to see the next video to understand how the AI crash will trigger a global banking freeze.